I look at break-evens, just to get a bit of a lay of the land with you. I look at break-evens, and investors are expecting inflation to be at the upper end of the Fed's kind of guidance for the next 5 years. The world we live in is with financial products that are geared towards benign inflation. How seriously should we take the warnings from the market?
So our view of inflation, I think it's similar to what you said, Yusuf, is some of the higher numbers we think are going to come down. Core inflation is more between 2% and 3% the last couple of months. As we work through some of the supply chain initiatives where we think this comes out is kind of 2 to 3%. Frankly, if it was at 2 to 2.5, I think it's exactly where the Fed would like it to be. They'd like some inflation. It's clear from what they've been saying. So we're not panicked about inflation, but it's certainly an issue. And we would think in kind of that 2 to 3% range.
I mean, in the past, you've said, well, over the summer that you expect rates to be sort of at the lower end as we get to the end of the year. Do you still stand with that view?
No, I'm not. I think they'll be at the higher end over time, not by the end of this year. So if you add to the inflation things that we're just talking about, the fact that the Fed's probably going to be tapering from now through the middle of next year. And if I look at the 10-year note, that 1.5 to 3% range that's been consistent for 15 years with very, very few exceptions, still at the low end of that range, I would think over the course of 2022, it's going to move toward the high end of that range.
I mean, with a potential inflection point in monetary policy, maybe even in sort of government accommodation programs, is it on your mind quite a bit that valuations are stretched in markets at the moment, regardless of asset class?
Well, when you look at the alternatives to investing in a zero interest rate world, I think it points people toward equity. And I wouldn't say they're stretched, but they're at least fairly valued. So I think it's very, very much going to be a sector approach going forward. I don't think anyone would say that the equity levels are cheap here for sure.
Let's talk about one of your key points of, let's say, interest and focus and allocation of resources, and that is around digital bank currencies, your involvement with Circle. What are some of the products in the pipeline, and then how does that put pressure on some of sort of the old school ways of banking?
Well, if you look at the earnings that came out of the big U.S. banks recently, they were phenomenal. But a lot of it was in the investment banking area and the asset management area, not kind of the core legacy bank. And to that, I think we'll see more of it. This is a bit of a segue in terms of the conversation, but certainly since the financial crisis, with the Swiss banks and the UK banks and the European banks de-emphasizing investment banking and focusing more on their core, the bulge bracket U.S. investment banks are just killing it. And it's almost like an oligopoly. The market environment is terrific. The advisory fees are strong. But if you go away from that, Yusuf, for a second and talk about core banking of taking deposits and making loans, it's frankly pretty sluggish. With the higher capital levels that came from the crisis, those activities feel a lot more like a utility. And I think that part of banking will benefit from higher rates, but it's getting hit a lot more from higher costs, lower loan demand, and they're getting hit particularly, to your point, from the technology specialists and the other specialists that are kind of invading the most profitable areas of banking.
So how much growth are you seeing in Circle specifically?
Yeah, so come back to Circle. We've recently announced our SPAC, Concord Acquisition Corp, is merged with Circle. We hope to close in November or December. And we see this as digital payments really competing with kind of that core treasury transaction services, commercial banking activity of the banks. It's not as much looking at the consumer side or the retail side, but that commercial side. So a very, very profitable portion of the legacy banks over years. And we think there's a real opportunity for Circle and others who have a digital offering, taking advantage of the internet, taking advantage of blockchain technology, the ability to steal business here in that payments and treasury and transaction services section of banking is real.
What about blockchain equivalents for corporate bonds and equities? That's another area that Circle is working on, correct?
The blockchain technology, I think, has been critical to allowing the payments business of Circle. And I think in addition to that, one of the businesses that we're building is the borrowing and lending of various digital currencies, right?
What about regulation, Bob? That's going to come in. It looks ripe for it.
Yep.
How do you think that's going to take shape?
Well, we need it. So it's probably not the answer that you were expecting, but I think, Circle now is very, very regulated. But the prime regulation is 46 separate states and a few in Bermuda and a few other places like that. And from the federal level, we really embrace regulation. We think regulation will be a positive for the stablecoin portion of the crypto business. And so we embrace it and we look forward to it. We've made a couple of announcements recently in Circle. One was that we're going to apply through the OCC for a full reserve banking license, which I think supports the fact that we would expect to be regulated as a stable coin or a digital currency. And we've also announced that the portfolio behind our USDC or stable coins moving to just cash and short-term treasuries. So, emphasizing that a dollar is a dollar is a dollar is very, very important, along with smart regulation.